Let's have a look at what we're covering this week. Number one is always the same each week. Rates and yields, real yields and OAS tied to specific assets. Also, you get to hear me complain about why the market is not pricing in more rate cuts, as I do every week. Number two, I'm going to show you a site called DefiLlama, where we can watch live as it gets, stablecoin market cap, as opposed to waiting quarter by quarter to tell First Circle to tell us here's how much we have in circulation. We can see every single day. We'll talk about the Iceberg Index. A lot has been said about that this week, and somewhat misinterpreted. SPY and earnings calendar, and our spotlight companies are Credo and Astera. We're going to go through understanding data center connectivity, because that is where those guys play. As I'm going to say every week, there is a button under there called like. It's a little thumbs up. Go ahead and click on that, and it would help me a lot if you subscribe. This pushes the YouTube algorithm higher, to push the video higher, to reach more people. In the description box, there is a link to an email list. You can click on that, leave your email name, and every Friday at 4 p.m. I email out the companies that I'll be covering on Sunday, and you get a 40-point infographic on each company, which tells you a lot about the companies. Their infographics and each of the points are in themselves AI prompts. So if you want those early and you want to keep a collection of those, just leave your email address and you will get those. I promise that's all you'll get. Some people use email addresses to then send you 3, 4, 5 emails every single week. Buy this, buy that. I won't do that. I will only send you those documents once a week. Okay, let's head in. It was a short week last week, 3.5 days, but it was enough by the end of the week to give us a small bull flattening on the capital market curve, down roughly about 4 or 5 basis points right across the curve. Not much going on in money market rates. Slope, pretty much the same, 0.55, the 2 to the 10. Last week, 0.55. The 3-month flattening a little bit, 0.14 from 0.16. Not enough information in there. KRE had a nice week. That is your regional banking index, up 2.24%. Dollar index giving up a little bit more. It seems to fail once it starts getting closer to 100, a little over 100. It gets pushed back down. I think you'll probably be somewhere between 98 and 100 into the end of the year. But I do expect the dollar index to put in another bad year next year. Year to date down 8.32%. Do that again next year. I think you probably get the dollar index down to about 90. My forecast remains the same for December 2026. Effective federal funds rate being in the 2 to 2.25 range. The 10-year in the 3 to 3.5 range, which would give us a much higher slope on the capital market and the money market to capital market. These are all positive for banks. So I think next year KRE will really start to perform as we start to see the new Fed chair consolidate their power. Let's run to the White House, say yes sir, no sir, I'll get everybody in line. Make the decisions about the Fed presidents in February, that only those that support the administration's vision will get reappointed. December ZQ 97.83 to 98, still the forecast. Let's have a look at what happened in equities, because it's been an iffy couple of weeks, but man, did we end November strong. Slightly below, less than 1% below all-time highs on SPY. Up 3.7% this week, 16.5% year to date. Add the 1% dividend yield on. IWM had one hell of a week too, 5.58%, 12.58 for the year. Pretty much the same dividend yield as SPY. Triple Q outperforming SPY, up 4.95%. Still the leader here up 21% year to date. Lower capital market yields does speak well for higher duration equities. IYR up 1.6%, XLP up 1.89%, is now positive for the year. Last year, staples were negative. This is a very defensive sector, is now positive for the year. Let's look at where we are on Fed funds futures. The effective rate 3.88%, Q1, the January ZQ, for Q4, 3.65, pricing in a rate cut. We're going to see on the next page, the probabilities are heavily favoring a rate cut. If I had to pick a number right now, I'd say, 25, negative 25 or 0, I'd say, well, it's got to be negative 25. I'd be far more in that camp. Q1, still not sure what you're going to get in Q1. 60% of a rate cut. Q2, one rate cut in there. Q3, 80% of a rate cut. So you're looking at 78.5 basis points to the end of September 2026. That's 7 meetings. That's 3 of them without Powell. It looks like we're probably going to get a December cut. So we can take that and say, well, roughly that's 50 basis points over 6 meetings, because one will be gone. Half of them with Powell, half of them without. You're only going to get 2 cuts. It just doesn't seem right to me. The market just doesn't seem to want to price in an irrational Trump Fed. Going all the way out to April 2027, you've got 93.5 basis points of cuts in 11 meetings. 7 of them without Powell. And if we do get, this is roughly about 4 cuts, if you do get one in December, you're saying you're only going to get 3 cuts in the next 10 meetings, with 7 of them with a new Fed chair. Do you see what's going on here? Is I have a hard time with this. I can understand all the way out to Powell is gone over here in May. You have a new Fed chair for June. So if we just drew a line straight up here, I can understand why the market would be pricing in a rational Powell Fed. But to be pricing in a rational Powell Fed for the next 2 years, from this there should be a kink, and ZQ should be going straight up like that to reflect the very real possibility that that is what they're going to do. Run to the 2% line very, very quickly. Now, one thing that hasn't entered the market yet, but that has occurred to me, is here's a question for you. I'm going to circle that question. I want you to think about this. What if the new Fed chair that we will learn about in 2 or 3 weeks, what if the new Fed chair advocates for a higher inflation target? Now, the Powell couldn't, because it would be seen as changing the rules of the game halfway through the game, because you're not winning. But the new one coming in could say, look, this was ridiculous, all of this backwards looking stuff. There's an accusation that the Fed had gotten too political, that it was concerned about certain equitable outcomes in the market, as opposed to looking at its 2 mandates. It started to adopt a social program as well. Well, we have to be concerned about this group and inclusivity and that group. There is that accusation being thrown out there. But the new Fed chair can come in and say, look, everything has been done wrong. We're going to start incorporating forward-looking statements. We're going to recognize that we're probably in a structural change in the economy, where employment probably is going to lag for a while because of the effects of technology. But technology will produce great productivity, which will keep GDP strong. So given our 2 mandates, GDP strong says don't lower rates. Unemployment or lagging employment says lower rates. It doesn't make a lot of sense. But what if they said, look, if inflation isn't coming from labor, where is it going to come from? If you have increased productivity, that always drives prices down. If you increase your inflation target to 2.5 to 3%, let's say, job done. We're here. We're at target. Now, this does take time to get done, probably Probably not going to happen in the first meeting, but the process could begin. That by the time you get to the fall, you have a new target. And if there is a belief that the Fed can reach a consensus on getting to a new target, it will begin to be priced into the market. What do you want to do in that case? Well, ZQ seems to be the natural winner there. It's going to give you lower real yields. If you have a higher inflation target, the break-evens will be higher, give you a lower real yield. And I think in 2026, with a further decline in the US dollar, gold will continue to perform. It seems to me that 5,000 before 3,500, I'd place heavier probabilities on that happening. 5,000 on gold before 3,500. The two drivers of gold, lower real yields and a lower US dollar, I think, are probably in the cards. Now, I'm not saying that the target will be increased. It just seems like a logical thing to do, given the fight you're having trying to get it to 2%. And the range really, when you say 2, the range is really 1 to 3, 2 over the long term. But if we're entering into a structurally different world because of AI, then maybe you're going to have that. One thing is for certain, you start moving those short-term rates down really, really fast. I'm going to show you in a couple of screens the growth in stablecoin. If you start moving those down really, really fast, Circle will be dead faster than I thought. Real yields have pulled back this week. Combination of lower dollar, lower real yields should be a boost for gold, and it was 3.78% week over week, 60% year to date. But look at silver. What a week it had, 12.96%, up 95% year to date. We're on 100% watch. Will it finish the year up over 100% year over year for, I believe, its best year ever? Moving into our break-even rates, they're all a little lower, suggesting that the bond market participants are willing to accept the lower break-even in anticipation of probably lower long-term inflation expectations. Energy and food down here, up for the week. CL up, but still down on the year, so lower gasoline prices now versus the beginning of the year. Natural gas is going to be a cold winter. It's going to be an expensive winter, up 33% from January 1st. Year to date, up 33%. Wheat and corn up for the week, but still down for the year. Your soy is up, pushing 9% for the year, up 0.95 on the week. Let's have a look at our Fed, December 10th. We get that next Wednesday, FOMC, and we're going to get summary of economic projections. We get a new dot plot, and this is where the participants decide where they want their dot. It's Stephen Mirren down here. It is going to look like that again. He'll be way the hell away from the crowd. 87%. Almost 87% on a 25 basis point cut, up from 71%. I think that's the right move. Going out to January, getting only one cut, whether it be December or January, 66.6%, up from 58. 666. You know, I've been seeing 666 in a number of places, more often than normal over the last quarter. I'm sure it's nothing. 50 basis point cut. Or 50 basis points would mean one in December, one in January, 22.7%. That's not insignificant. Greater than a 1/5 chance that you'll get a cut followed by a cut. Reverse repo, 7.5 billion. It always increases into the end of the month and then drops down after that. Repos at zero. Reserves, 2.89 trillion. TGA, 899 billion. Still sitting at the 900. Are they going to pay anyone? Seems it should have dropped by now, but maybe everyone gets paid at the end of the month, which means since it's a Sunday, they'll get paid Monday. I don't know. Maybe they got paid today and it didn't clear. I don't know. Or paid on Friday and it didn't clear. It didn't register yet. But you're going to have to pay everybody and pay all that back pay. When's that thing going to drop? Maybe they're not paying anyone. Back to work, but you're still not getting paid. Corporate spreads tightened this week as well. Looking at our ETF for mortgage-backed securities, up 0.29 for the week. Agency and Annaly being the big winner here, up almost 4% on the week, pushing up to 25% year to date. This is price. Add on yield for another 12%. You're looking at 37% out of a little guy like that doing nothing but mortgage-backed securities guaranteed by the U.S. government, or at least a de facto guarantee. 6.23 on the 30-year fixed. If we get a rate cut in December 10th, if it travels through to the rest of the curve, we just might print a 5 handle on this thing. And once you start seeing a 5, housing starts to get a little bit more interesting. This is the governor projections for 2025 and 2026. This is going to change dramatically next Wednesday. But this is for the end of this year. The median was 3.63, implying 1 cut. And if you go out to the end of 2026, it's 3.38. Well, if we get 3.63 by the end of this year and 3.38 by the end of next year, the governors are saying only 1 cut in 2026. Now, this summary of economic projections was done with Stephen Mirren in the room and Trump screaming that Powell is too late, that rates should be 100, 200 basis points lower, and the governor still said, no, we see 1. We see 1. Even though Powell is gone, he won't do it, will he? He won't do that, will he? And we said the same thing about tariffs. Oh, he won't do that, will he? Yes, he will. Let's have a look at our economic calendar for next week. I use Trading Economics for their calendar. You can set whatever country you want. Look how comprehensive this is in terms of country. You can pick them all. I just have Canada, Mexico, and the U.S., basically North America, in here. But somehow, the European Union with their bond issue want to show up there anyways. In case you're wondering, why do you have Euro bonds there? I don't. It just muscled its way in. Maybe it's trying to tell me something. Buy us. What do we got coming up? Monday, ISM manufacturing at 10 o'clock. There was no interruption in this, so notice a little gray writing here. We get that for November, so that is current because that's not government data. It's private data. So we'll be getting that. And looky. At 8 p.m., Fed Chair Powell is going to be speaking. Next day we have Bowman. Don't have anything too exciting the next day. Going into Wednesday, we have ADP employment change. We're not getting the job numbers this week, but ADP is private, stays on its schedule. So we're going to get the employment change. And we get some data from the U.S., but still, it's, if you look down, it's all for September. Export and import prices for September, really backwards looking. It's not going to help the Fed very much because this is for September. Should have got this in October. We're at the end of November now. ISM services for November. We get our oil and gasoline and heating oils inventory report Wednesday at 10:30. Going into Thursday, that'll be interesting to watch. The Challenger job cuts, 7:30 in the morning. We get initial jobless claims. That will be up to date, November 29th. And if you follow Nat Gas, you get the Nat Gas inventory report on Thursday. Anything exciting here? Bowman is in here. The Fed balance sheet is released at 4:30. And going into Friday, Canada is on time. We're going to get jobs numbers for Canada. And, it's, PCE, we get that. But keep in mind that is September core PCE price index. You also get Michigan consumer sentiment in there as well. And then the week after, the calendar, only one thing matters next week, and that's going to be the Fed. This site, rather interesting if you want to follow day to day what the issuance of stablecoin is or any other currency. This is DefiLlama. I have the link in the description box below. I'm on the screen for total stablecoin market cap, 306 billion USDT. That's Tether, 60.31% share. I just want to zoom in on something here. Let's just zoom in here. See this inflection point here where you're going sideways and then up we went over here. This is the election. Trump won. Yay, stablecoin is going to be great. Let's go all the way out to July 18th because that was the passage of the Genius Act. And let's find July 18th. And then after that, since the Genius Act had passed, that is the growth rate. It's a rather small growth rate overall. Your biggest growth was in anticipation of this. It's basically been going sideways for the last little while. In fact, it shrank a little bit. We want to see USDC if you're interested in tracking Circle, because Circle had a big week last week, back up to $80. I'm seriously considering a short on that one. Market cap 76.21 billion. At the end of the previous quarter that they reported, it was 73. We're up to 76. This growth is way too slow. You can see the big growth that they've had if we go to November. Let's just zoom in on this a bit. And let's find November. I think we're somewhere there. Let's find July. Actually, sorry, we have to go back to last year. And let's find November 2024. I think it is right. I'll get it. Give me a minute. There it is. So from this point onwards, this was Trump winning the election, and up we went. And if we go out to the July 18th, there we go. That was the Genius Act passed. Not very impressive growth after that. The biggest percentage of their growth was from the election, and I did calculate the numbers. Let me see if I can find them here. I should have had them more ready, but let me do a few clicks. Here we are. So let me give you some numbers here. Their growth from November 2nd to July 18th, 82% growth before the introduction of the Genius Act, 82%. Since then, their growth hasn't really been that impressive. 20.74% from the introduction of the Genius Act, but it's been flat since about early October. They're not growing fast enough in terms of their circulation, even at 20% over that period of time. It is not fast enough to overcome the rate cuts that are coming. And remember, 96% of the revenue is derived from Treasury income. Much of their revenue is going to be taken away from them over the next 12 months. And given the growth rate in stablecoin issuance that we're seeing here, and we can see the update day to day with this site, rather than waiting each quarter going, I wonder how they're doing. We can go to this site and just look at the issuance every single day and determine whether or not they're growing fast enough to overcome the cuts that are coming. If you have rates that are cut in half over the next 12 months, just for their revenue to be flat, they must double the amount of stablecoin that they have based on the increase they've had over the last 5 months roughly. They've increased the stablecoin issuance by about 12 billion. Not going to happen. Not going to happen. So their revenue is almost certain to begin to decline. I thought you might find that site interesting, DefiLlama. Here is an interesting paper. The Iceberg Index, measuring skills-centered exposure in the AI economy. This got a lot of headlines this week because of the conclusion that it reached. Even though within the paper it says we are not predicting job losses. We are predicting the percentage of tasks that AI can do that humans are currently doing now. Whether or not that leads to job losses, they conclude we're not going to say, we can't say. It's just there's this overlap. But it got a lot of press saying, oh, it's 11.7% of jobs are at risk. That's not what it's saying. Of all the tasks that humans are doing and all the tasks that AI are doing, it is saying there is an overlap of 11.7%, but that could just simply mean that 10% of my job AI can do. Well, you're not going to get rid of an employee that's doing 90% of the work. Now, so there will be some job losses, and the paper does admit that, and the paper does sort of highlight where things are happening now. Link to this is in the description box. I've highlighted just a few points, so let's just read some of the highlighted points here. Research indicates each high-tech job correlates with approximately 5 additional positions in local services, healthcare, and retail. That's a big deal, because if you think, oh, it's only going to really affect these types of people, only these types of jobs, it's that ripple effect through the economy. Each high-tech job correlates with approximately 5 additional positions. Okay, let's see what else we have here. Evidence suggests workforce change is occurring faster than planning cycles can accommodate. Payroll data covering millions of workers show a 13% relative decline in early career employment, age 22 to 25, for AI-exposed occupations. Analysis of job postings across 285,000 firms for 62 million workers reinforces the pattern. The demand for entry-level positions has subdued while the focus has shifted to hiring for experienced roles. And I've made this point before and many times before that the gains to AI will accrue to expertise. Non-experts will find fewer jobs, and of the jobs they find, more wage pressure on the downside, whereas experts will find their wages bid up very quickly over the next 5 years. That I would expect the top 10 or 20% of performers across organizations over the next 5 or 6 years to maybe even double their salary, but those at the bottom, probably 20-30% of those jobs would disappear. The lower level jobs would disappear, with wage gains coming much slowly. What else we got here? We got a few more things to read. Let's scroll down. This is what they're sort of getting at here. This is visible tech adoption. So what they're saying is, this is a surface index, 2.2%, that you can look at certain jobs saying, oh, those coding jobs are gone, that's gone, that's gone. These are the really visible ones. It's what's below the surface. This is why they call it the Iceberg Index. 11.7%, 5 times larger and distributed across all states. Hidden cognitive automation. AI expands to cognitive work, finance, HR, customer service. Where else have I highlighted? Let's keep scrolling down. There's a lot to read here. That's why I leave you the link. In 2025, more than 100,000 job losses were linked to AI restructuring. AI systems now write over 1 billion lines of code each day, exceeding human developer output. Nationally, the surface index stands at 2.2%, representing approximately $211 billion in wage value across 1.9 million workers in technology occupations. This includes software engineers, data scientists, analysts, program managers, and related roles where current AI adoption is concentrated. That is this part that we saw up here. Up here, let's get to this iceberg part here. Let's find our next highlight. Beyond technology occupations, AI capabilities extend to cognitive and administrative work. Some adoption is already occurring. IBM reduced HR staff through AI automation. Salesforce froze hiring for non-technical roles. McKinsey projects that 30% of financial tasks could be automated by 2030. We know OpenAI is going after your Excel ninjas. your spreadsheet modelers, not the CFAs that come up with all of the forecasts for how each line item should be forecasted, or come up with all the assumptions of how it should be forecasted, but the ones that actually input it into the spreadsheet. 30% of financial tasks. The Iceberg Index for digital AI shows values averaging 11.7%, 5 times larger than the 2.2% surface index. Have we got any more highlighted here? And no, that would be about it. I'll leave the paper for you. But when we keep hearing that companies saying, well, we're not seeing this, we're not seeing that. And as we read earlier, one of these jobs ends up being 5 of these jobs. If this is 2.2, multiply that by 5, you get about 11%. There's that 11%. I finally got, I had one prompt that I was using, and no AI could get it done. Even DeepThink couldn't get it done. Gemini 3 finally got it done. It's about 70 to 80% good, which is good enough for me to work with. Every time I tried this particular prompt for this particular task, it was so far away that I may as well just do it myself. Now Gemini 3 can do it, and it is considered a cognitively intensive task. And it's 70 to 80% of the way there. That if organizations are saying, wow, we're just not seeing what it can do, and this is just LLMs, never mind about the coming army of robots, and they are coming. They are coming. Maybe not this year or next year, but sometime in the next 5 or 10 years, they are coming. That your central banks around the world aren't looking at this saying, this is going to be an issue, but still looking in the rearview mirror about the way things were and not the way things will be, while this is going on all around them. Irresponsible. Let's get to SPY. A couple things to note. All-time high, still October 29th, 687.39, less than 1% below that, 0.55. Looking at IWM, at 248.75 is 0.63% below its last all-time high. Triple Q's down 2.6% below their all-time high. Closing 68.49 forward. Operating earnings 296, 23.13, back over the 23 times forward earnings. And every time we peaked above 23, the market gets jittery. You can see this sort of tight band that we've been in, this consolidation zone that we've been in for a while. You've had your pullback, and then you basically had a straight run up, and now we're in our consolidation area. Are we going to break out above that? Typically, when you have a trend with a consolidation, the trend usually continues in the same direction. Of course, barring any exogenous event like a bankruptcy or a liquidity crisis that comes out of nowhere, that nobody saw this coming. You can't predict those, so there's no point in trying to predict those. That if you had to flip a coin and bet, you'd probably say, well, based on lines I could draw on charts, and based on other lines I can draw on charts, the weighting is probably to the upside. December's a funny month. Usually it's mixed for the first week or two as you have tax loss harvesting going on. But as far as I can remember, these things, the markets tend to drift higher into the end of the year. So your first couple of weeks might be iffy, and then we'll drift higher. I think the direction for the end of the year is going to be heavily dependent upon Jay Powell and the crew. You get a cut, yeah, you're going to drift up and to the right into the end of the year. Some new price targets coming in for the end of next year, by the way. 780, I believe, was Morgan Stanley or JP Morgan put a 780 on SPY by the end of next year, while 7,800 on the index. But usually you just divide it by 10 to get SPY. Implied volatility drifting away as well, saying we're over 23 times. That is less risky than when we were only at 22 times, right? Drifting away. We do have some earnings this week. Tuesday, CrowdStrike. Wednesday, we have Dollar Tree, followed by Dollar General the next day. You also have Salesforce.com. You have Kroger and Hewlett-Packard Enterprises in there. And, of course, you have our Spotlight, one of our Spotlight companies. Oh, hang on. Sorry. Monday, after the close, CRDO. Very high IV on this one, as you'll see. I would anticipate that the front contract on the options for expiration might hit up to about 200% IV. We'll see what the straddle looks like on that to determine whether or not there's an interesting earnings play in there. Let's move on to our Spotlight company now. This week we're going to take a look at two companies doing the same thing, just in different ways and in different places. Credo Technologies and Astera Labs, and we're going to see if we can't get our heads around the market segment of data center connectivity, especially when it comes to AI data centers. If you have the Applied series on the site under Sector Studies in Information Technology for semiconductors, you'll find a PDF for Understanding Data Center Connectivity, which looks at the problem that is being solved in a deeper way and looks at both Credo and Astera Labs and how they're solving that problem. Also, in the description box below the video, there is a link where you can leave your email address, and every Friday at 4 we email you the it's an infographic, 40 points to know about the company. We email you that at 4 o'clock on Friday, so you have sort of a heads up as to what we'll be looking at Sunday. Those of you that did sign up in your email, you noticed that you had two of them, Credo and Astera. So if you want these emailed to you on a weekly basis, just leave your email address with the link below. On the screen, I have two charts. Top chart is CRDO, bottom chart is ALAB, both one-year charts. Market cap as of Friday's close, $30.72 billion for CRDO. If I give it a growth rate of 20% quarter over quarter, which is aggressive for CRDO, I get a forward price to sales of 26.4, elevated for the space that it's in. ALABs has a smaller market cap, 26.61, and fits this a little bit better. If I give it a growth rate of 20% quarter over quarter, it is a little, it's not as aggressive for ALABs as it is for Credo. You get a forward price to sales of 21.5. So given the same growth rate, it's got a lower forward multiple on sales, and that growth rate is more than likely better fitted to ALABs than to Credo. And it shows up in the IV for CRDO, 100.1%, which makes it a nice stock to play on volatility. For ALABs, much lower, 72.8%. That becomes a lot riskier to play for vol because your exits are thinner. They're both solving the same problem, just in different ways. The problem is signal integrity and between connections. So signal integrity connectivity. Credo does it between the boxes. ALABs is focusing within the boxes. They're both fabless. Customers are both hyperscalers, OEMs, and that's true for both. To think about connectivity and how we can place it in our minds, think about a body. I'm going to use a body analogy. The GPU and all the GPUs, these are the brains of the body. The data center is the body itself. You can think of Credo and Astera as the nervous system. It's all the connections between all the boxes and all the connections within the boxes. Chips and cables that allow data to move between brains fast enough to function. If you are playing vol on Credo, this is how I would play it. Delta benchmarking to a call, which means you're going to be short 195 or 12 days to expiration. Okay, let's figure out what problem it's solving and then we'll look at each company. What helps us understand what both these companies do is to get an idea of the evolution of the architecture of a data center and introduce a physics problem. The problem that these companies are solving is not one of efficiency or one of cost reduction. They're not a nice to have. They are a need to have. They become mandatory when we move to AI data centers. So let's just contrast what a data center, a typical data center without AI used to look like. You would have racks of servers, each server being an independent unit of compute, meaning its own processor, its own hard drive, its own memory. Tasks that it processes are relatively independently partitioned. So communication between servers, if necessary, went through a switch, which was the traditional means of connection and communication. However, once we move to AI, switches would just add a whole bunch of latency. You need these GPUs talking to the other GPUs directly. A cluster with constant all-to-all communication. So connectivity becomes critical. You have hundreds of GPUs within a rack that need direct, high bandwidth connections to each other. So the switch, as I said, creates bottlenecks and adds latency. So within a server, you need all the peripheral components to be able to talk to each other. You need communication between them. And you need this type of communication. It's many to many. And here we go here, and this one has to communicate here. You can see all of the connections that are happening. It's not just a matter of everyone connected to a switch and everyone working. Here you go, and then you go over here, and then here's my answer. It's many to many. Here's the physics problem. Let's start with a simple signal. A processor processes information in parallel, but if it has to send information out through a copper wire, it is done serially. So you have to turn all of that into a serial message. Zeros and ones. 0 volts, meaning the bit is a 0. 1 volt, meaning the bit is a 1, and that's what travels through the signal. And the other side receives it, says, okay, no volt, no volt, no volt, 1 volt, 1 volt, no volt, no volt, 1 volt, and it then can deserialize the communication and put it back in parallel. Electric signal travels through a copper wire with multi-gigabit per second data rates, but we do have limitations. Copper has resistance, so it attenuates the signal as it travels. Attenuate means this is what happens to the signal. It tends to lose its distinction. This square waveform becomes more rounded. The further you go, the more it attenuates till you go long enough. There is no signal that the receiver can understand. So there is a distance limit. That limit shrinks the higher the data throughput gets. We'll see how short that distance actually is, because remember, inside the box, we have to put a bunch of peripherals. If you put them too close together, you generate a lot of heat. Oh, that's not good. If you put them too far apart, you end up with this problem over here. So we need to solve that. The dielectric material surrounding the copper also causes some of the signal energy to leak away as heat. So you have a copper wire, and then it's never just a copper wire. You don't see copper. It's wrapped up in a composite material that then shields the copper wire. The high frequency components of the signal attenuate much more severely. So here is your nice square waveform. The larger the distance you travel over, it starts to attenuate. You go too far, and pretty soon the receiver has no signal that it can understand. I'm going to introduce a little bit of terminology before we dive in. The idea of a channel loss budget and decibels. Also, I'm going to be using the term gigatransfer. So if you have perplexity, head over there and say, what is a gigatransfer? Because it's the throughput is measured in gigatransfers. How many gigabytes per second that is depends on a few things. Perplexity will explain that to you. I don't want to get too deep into the science of all of this. So what's a channel? It is everything the signal passes through. What is a loss budget? Let's start with PCIe 5 standard. PCIe is Peripheral Component Interconnect Express. Operates at 32 gigatransfers per second. Has a total channel loss budget of 36 decibels, which translates to about 6 inches of channel. That's what it's saying is the most that this can lose is 36 decibels, and I'll explain here what a decibel is. It can lose up to that much before the receiver can no longer understand it. So that's the total loss budget. It's only about 6 inches with PCIe 5. Once you move to PCIe 6, look at this, it drops 5.4 inches, which means you need to intercept that signal, clean it up, and send it on. If you double the speed, you're at 64 gigatransfers, drops to 32 decibels. It's measured in decibels, so let's deal with that because you will hear that term. It's a logarithmic ratio. 3 decibels means half the signal power. So if you start with a certain signal, after a certain amount of time, it drops to half. 3 more decibels drops to another half, and it keeps dropping by halves. So 10 decibels is 1/10 the signal power. So if we want to know what 36 decibels is, it's 0.5 to the 12, and the receiver can still understand it. If you drop to 32, it's 0.5 to the 10.666. This is 2.52 times higher than if you were at 32, which means much shorter distances before the receiver can't understand it. So as the data throughput increases, the distance at which the signal can travel through passive copper wire shrinks. So you have to turn that passive copper wire into active copper wire, which says, okay, well, if you can only travel 5.4 inches, I'll sit there, I'll receive the signal, and I'll clean it up somehow and send it along. And if I do that right, I should be able to get another entire channel loss budget out of the next move. And that's what Astera attempts to do inside the box. A higher throughput tolerates less loss. Therefore, a fix is required more often for the same distance if you're going from the 5 standard to the 6 standard. The loss budget is equal to the total degradation a communication link can tolerate while maintaining reliable operation. As data rates increase, budgets tighten. So we have to say, well, listen, are we going to get more AI data centers? I think so. Are data transfer rates going to increase or stay here? They're not going to decrease. Are they going to stay here? Or are they going to increase going forward? The faster the processors get, the faster it can send information, those data transfer rates are going to increase. So not only are we going to get more AI data centers, it's going to increase, which means you're going to need many, many more of these active components. So as I've said on the previous screen, passive copper cables face very hard distance limits. When we say passive, we mean here's a copper cable, go ahead and send a signal down. You're not doing anything to the cable. So the solution is either put everything really, really close together. That would generate too much heat. It's not going to be effective or efficient. Either do that or introduce active components. This is where Credo and Astera live. Any active component does cost additional power, though. So it's not a matter of, okay, here you go. There's lots of solutions for it. It's a matter of cost. You have potentially hundreds of thousands of these active components, all taking 3, 4, 5, 6 watts, can add up to megawatts overall. So you can't just have a solution. You have to have a power-efficient solution. Let's introduce the notion of serializer, deserializer. You will see this CRDES. That is serializer, deserializer. Let's start with the transmitter and the receiver. The transmitter could be processor or memory. Bits are processed in parallel, 512 or 1024 bits wide. However, they travel through a copper wire serially. So you have this big amount of data that is in parallel form, 512 bits, but it must travel one at a time through here, so you have to serialize it on this end, send it through the copper wire, and deserialize it on this end. As they're traveling through the copper wire, they do travel at much higher speeds. You may think this may slow everything down, but you can travel up to half the speed of light. Traditional method, the NRZ, non-return to zero. We're going to see that the way we serialize things through copper wire has changed, but this was the traditional way, where you had either 0 volts or 1 volt representing a bit that was either a 0 or a 1. 1 bit per signal transition. So going from a 0 to a 1 in voltage is a signal transition, 1 bit. If you wanted to increase the throughput, you signaled faster. But the signal attenuation becomes worse. So the faster you signal this, keep in mind, you can still sort of, even if this attenuates, you can still sort of tell when something is closer to 0 or closer to 1. But when it's, the faster you put it together, it becomes harder and harder. It'll attenuate a lot faster. Pulse amplitude modulation. You may see this term PAM4, 4 distinct voltage levels. So on the last page it was either a 0 or a 1, depending on the transition. Here we have 4 distinct voltage levels. 0 volts, 0.33, 0.66, and 1. 0 volts is 0, 0. 0.33 volts is 0, 1. 0.66 is 1, 0. And 1 volt is 1, 1. Notice we're sending 2 bits at a time, not 1. You're moving 2 bits instead of 1. That's twice the data rate at the same signaling rate. You're not increasing the frequency of the signal. You're keeping it the same, but instead of just a 0 and 1, you have 4 different voltage levels. Now think about trying to decipher this as it attenuates, right? As it attenuates, you're looking at certain things, and it was easier before. You can go a longer distance and still say, well, clearly this is closer to 0, this is closer to 1. You could make the decision that this cannot possibly be a 0, this cannot possibly be a 1. But what is this? Is that 0.33 or is that 0.66? It becomes a little bit more difficult unless you clean that up. But if you're going to send more and more data through as 1 bit at a time, there is a limitation to that as well. So this has become the standard. PAM4 at 32 gigatransfers per second is the same as non-return to 0 at 64 gigatransfers per second. But the receiver now has to distinguish between 4 voltage levels, not 2. Voltage spacing is tighter, therefore it is much more sensitive to any form of signal degradation. How do we fix this? We have 3 classes of devices to boost passive copper's capabilities. The first one's not really used anymore, called a redriver and amplifier. Relatively simple, low power, and it adds minimal latency. However, it amplifies what it receives. It amplifies the signal, amplifies noise, amplifies the distortion, cannot distinguish between them, so it's not effective at current data transfer speeds. Next category, retimers. These are chips. Fully recovers the data and amplifies a new signal. So we can think of a transmitter. We've serialized the data. It's traveling through to get to your retimer, which will deserialize the signal, process it, get rid of everything else but the signal itself, and then serialize it and send it out clean as if it came out of the transmitter. So you can use your entire channel loss budget to get to the retimer, and then you have your entire channel loss budget again. Passive PCIe 6 can go through about 4 inches of board trace before the receiver cannot read the signal. You add a retimer in there, you can get to 12 inches. Now, it's not just a chip. It's a smart chip because it does provide information back, meta information about the signal itself. Provides telemetry and diagnostic capabilities. And when I say it does this, not all of them do this. This is what ALAB is focusing on. is making them smart in this capacity. Provides telemetry and diagnostic capabilities. Does require more power than a redriver and more latency due to the deserialization, the process, and the serialization. ALABs is big here. Next category is active cables. Credo is big here. The retimer or any other signaling condition is integrated into the cable assembly itself. Active electric copper, their product here is Highwire for 800 gigabit or 1.6 terabit. If this is sort of the coming standard here, a move to 1.6 terabit per second makes active electric cables mandatory. It's not as if you have a choice anymore. And going beyond active electric is active optical, which sends the signal through light. You can go a lot further with light. Why not just use optical for everything? Why bother with copper anymore? Well, more CapEx. It costs a lot more, and more OpEx. There are more active components in optical, so your running costs are higher. Your CapEx is going to be higher, and your running costs are going to be higher. With active electric, your CapEx is lower, and your running costs are about 50% lower than they are with active active optical. Not only that, active optical has many more active components, so many more points of failure. However, the move to active optical may be inevitable as data transfer speeds increase. Okay, time to take a closer look at these companies now that we have the problem that they're trying to solve clearly in our minds. Let's look at Credo. IPO January 2022. Their serial deserializer is deployed across 3 product categories. This is their IP there. They have a really good IP in this space. Number 1, active electric cables. This is their core product, the Highwire product. One cable can replace 8 or 16 separate connections per GPU, depending on what speed or what throughput it is. In active electric cables, they are the market leader. 100,000 GPU cluster would require 800,000 or 1.6 million individual connections, depending on PCIe 5 or 6. Each requires power about 5 watts, each one of these connectors. If you sum it all up, you're anywhere from 5 to 8 megawatts versus just buy 100,000 cables. You got 100,000 GPU clusters, buy 100,000 GPU cluster, you need 100,000 cables. Optimal solution for short reach applications, meaning connections within a single rack or up to a nearby rack up to 10 meters. So think about a cable. And you have a chip at one end and a chip at the other end. That is the integrated circuit. Low power on each one. This is Credo's claim, is that they can make these things with the lowest power consumption. Up to 50% less power than if you were using optical. Lower energy costs. Lower energy costs, less heat is generated, less heat, reduced cooling requirements as well. And they claim 1,000 times more reliable than optical solutions, because optical solutions have many more points of failure. They claim it. I'm not stating that this is the case. This is the claim that they make. Second category, DSPs, optical digital signal processors. Optical transceivers require a digital signal processor, and Credo supplies these to manufacturers of optical transceivers and optical cables. Sounds odd, right? They compete over here, and in this space, they say, hey, we're better. We're better than optical. Oh, by the way, you optical cable producers, we'll sell you some stuff too. 50 gigabit to 1.6 terabit using PAM4. And this is used for longer reach applications. Because of the sheer amount of power that all these individual connections would take, it makes sense to use these cables. And because of the greater power consumption that optical will take, for short distances, you'll continue using copper. But for longer distances, because, as we say here, up to 10 meters for longer distance, that is where optical lives. The third product category is integrated circuit and IP licensing for retimer chips and their serial deserializer IP. Doesn't really make up a lot of their revenue. Let's take a look at their income statement from their last quarter. We have 3 months ended August 2nd, 2025 versus August 3rd, 2024. They have earnings December 1st after the bell. Today is November 30th as I do this. So tomorrow night after the bell, they have earnings. They've already given us guidance for what to expect. We'll talk about it here, but let's break down what they have. As far as revenue, have a look at their revenue in product sales. Last year, 57 million for the quarter, 217 million. That's a 278% growth rate. 95% of that growth came from active electric cables. It is their dominant product. So even though we've talked about 3 different categories, it's very, very small. The second line, IP license revenue, you can see in relation to product revenue how small it is, but still the growth, 2.3 million to 6 million. The product revenue made up 96% of their sales last year, 97.3% this year. We have our cost of revenue, 37.6, dropping to 32.6, which means we have gross margin expansion, 62.4 to 67.4. Huge revenue growth, margin expansion. That all looks good, doesn't it? The IP license revenue, 152% growth year over year, primarily due to a new customer. This is where it gets a little bit risky. The types of customers that both Credo and Astera have are by their nature in very concentrated industries. There's maybe 5 or 6 global hyperscalers and they all have them as customers, and really that's about it. Credo identifies customer A and customer B. Customer A is 50% of their revenue. Last year it was 56. Customer B didn't exist last year. This year it's 35%. 85% of the revenue comes from 2 customers. Customer A is 50% of the revenue, but is 68% of their accounts receivable. Customer B, 35% of revenue, is 21% of accounts receivable. So you have, well, it would stand to reason, right? If you have revenue concentration with a few customers, you're going to have accounts receivable concentration with a few customers as well. Share-based compensation, that comes out of your cost of revenue, research and development, general and administrative. It's spread out over all of these. 35.4 million versus 16.6 million. If we look at their total costs, we have 72.7 million here added to what do we have? Total operating 89, 161 million. 35 million of the 161 is share-based compensation. They gave Q2 revenue guidance. It's ho-hum. Look at their revenue here, 233 million for this quarter. For the next quarter, they're guiding revenue 230 to 240. Midpoint is 235. They did 223. Not a lot of growth there. The reason there's not a lot of growth is you have to think about the transition, or it's not so much the transition, but how a customer becomes a customer. They don't just call up this company and say, hey, give us tens of thousands of cables. They'll call them up and say, we're going to buy 1,000 cables from you. And they're going to test it. And that may take a couple of months to test. And then later the order will come. So in this particular quarter, a large customer that began testing their cables came online, but they don't anticipate the next large customer coming online for the next quarter. So the quarter is guided kind of flat. Gross margins of 63.5 to 65.5. We had 67.4. So they're expecting lower gross margins, and their OPEX 96 to 98 million. We have our OPEX here of 89.6 million. So they're guiding to higher OPEX, lower gross margins, and slightly higher revenue. Doesn't look that exciting, right? Net income, 60, almost 60, call it 64 million, 28.4% net income margin. Difference between basic and diluted. They do have some dilution here. This partially represents warrants given to Amazon for 4.1 million shares. You can see the difference between basic and diluted shares, about 12 and a half, 13 million. 4.1 of those to Amazon. These warrants, strike of $10.74. You got a stock that is 170 some dollars now, so it's clearly in the money, clearly worth Amazon's time and effort to convert. Take the shares and sell them, take your money. They are fully vested. They are simply not exercised. Let's move over to Astera. Ex-Texas Instrument engineers, 3 of them, that started ALABs, I believe, 2017. Big thing here, the intelligent connectivity platform. Semiconductor-based high-speed mixed signal products, microcontrollers and sensors. Chips are smart retimers, meaning that you get information out of them. Run a software suite to help data center managers monitor link health and debug fleet issues. Their software is called Cosmos. It's embedded right into their products. Collects telemetry across all Astera devices. I want you to think about this for a second. You put another Astera device in, and it adds to all of the data that you're getting. So that increases switching costs, and it produces lock-in effects. Spans multiple communication protocols, PEI E6, CXL, which is Compute Express Link, allows processors to share memory and storage across distances. So you can put your memory and your storage in different locations. It doesn't all have to be in the same box. They are betting big on this one. And Ethernet in terms of the communication protocols. Their core product, Aries PCIe 6 and CXL3 DSP retimers, 64 gigatransfers using PAM4. Passive distance 4.3 inches using their product, extends it to 9.9 inches. Aries smart cables, they do have that, similar to Credo. Passive would be 3 meters. With the Aries cable, you can increase that distance to 7 meters plus. Credo can be up to 10 meters. A little bit more in their product lineup. The majority of the revenue, as I said on the previous page, comes from their Aries series. Scorpio smart fabric switches allows compute, memory, and storage to be allocated independently. They're hoping that CXL and their products in that space are going to be the next big thing. Leo CXL smart memory controllers allows processors to access memory at a distance. Taurus Ethernet smart cable modules, network connectivity, broader connectivity across racks and between data centers. Active cable solutions for Ethernet connectivity up to 400 gigabit per second. Really can't compete with Credo in that space. Acquisition, AIX Scale Photonics. They are both I should mention, Credo and Astera have made acquisitions in the optical space. They're both positioning for what is, I think, and I think they believe it too, the eventual move to optical active cables, even for shorter distances. So right now, the use is active electric cables, which probably will move more to a hybrid electric optical and eventually optical connectivity. Time frame for that, and things move fast, about 2 or 3 years. They don't quite have it yet, and they're competing with giants out there, Marvell, Broadcom, which have significantly more cash and resources than these 2 small guys have right now. So they have to move into the space at the very end. When we look at the tailwinds and the threats, the faster move to optical is a threat for both these companies. Let's look at their income statement. we have 3 months ended September 30th, year over year, and 9 months ended. Why didn't I give you 9 months ended for CRDO? They didn't present it. Only 3 months ended. First thing that jumps out at you is the low level of U.S. sales. 5.2% of 2025 revenue, 3 months ended September 30th. 5.2% is U.S. sales. Last year was 4.76. Singapore, 41% of revenue. China, 33.6. Taiwan, 16.3%. Growth rates, if we're looking at 3 months, year over year, 104% for that quarter. For the first 9 months, it is 128% growth year over year. The margins, 77.7% last year versus 75.7%, so a loss of 200 basis points on the gross margin year over year. For the quarter, 77.7 to 76.25, so lower gross margins both in the 3 months ended and the 9 months ended. Share-based compensation coming out of cost of revenue, research and development, sales and marketing, general and administrative. Anywhere you have an employee doing something, you're going to have share-based compensation. 9 months, 118 million versus 186 million the year before, so it is a little bit lower. Customer concentration exists here. They identify a bunch of customers. Customer A is 27% of revenue, 19% of accounts receivable. Customer B is 23% of revenue. So their top two customers are 50%. Customer C is 10. Customer D is 24. 84% of their revenue comes from 4 customers. Now they do face a slightly greater threat than Credo does. And Credo faces a slightly higher threat in terms of commoditization of their product. Not so much with Astera, but we'll get to that on the next screen. Customer D, 22% of their accounts receivable. And customer G must be less than 10% because they don't list it. They list anything 10% or higher. Customer G is 13% of their accounts receivable. Basic, 54 cents a share. Diluted, 50 cents a share. So we know that we have some warrants or stock-based compensation that is in the money. And they were profitable, 54 cents. Last year, they had lost money. Last year, for the first 9 months, they lost money. This year, they are making money. Good balance sheet, too. Can't knock this one. It's fairly clean. Very, I'm not going to say asset heavy in the sense of fixed assets, but very good assets. Cash and cash equivalents, cash equivalents, marketable securities, 1.1 billion, zero debt. Their liabilities are simply working capital liabilities only. Equity, 1.27 billion. They do have an accumulated deficit of 34.6 million. Okay, let's look at positioning for these two in terms of what about now and what about the future and who has the advantage. Right now, advantage ALAB. It is a bet on the complexity of clusters, whereas Credo is a bet on pure bandwidth. Every GPU requires high-end PCIe retimers. ALABs has a near monopoly here, and their smart approach offers product management visibility that Credo does not. This is what gives them sort of an advantage now. Swapping out a retimer requires rewriting monitoring software and firmware, so it is a much bigger undertaking. Whereas if you come to me with your active cables and somebody else has active cables, I really just have to test them. And I can change my cables anytime. But once these retimers are integrated into the architecture inside the box, it's pretty much in there. For the future, if data center architecture moves to composable infrastructure, meaning memory, storage, and compute are all separated into different boxes and connected by CXL, this is a huge outcome for Astera. So if you think this might be the trend, saying, well, you know, what do you need to have memory, storage, and a processor in the same box for? Couldn't you have them in different places? If you do, they have to communicate. Astera has a huge advantage there, and if you think that's where it's going, this is the one to play. Credo benefits from increasing speed. They don't need a new architecture for this to play out. You do need the industry to move to that architecture. Well, what if they don't? Then that bet is not going to pay out. It is a big bet that Astera is making that's where they're headed. Credo doesn't need any new architecture. It just needs higher speed, higher throughput being required, which means GPUs that can process faster and faster and faster. And that benefits them. However, their market is more susceptible to commoditization. Cables, even active ones, are easier to source and integrate. The tailwinds for both companies, just the sheer size of models, they just keep getting bigger and bigger and bigger. You need higher speed connectivity the bigger these models are. Risks, big one. Can you see it? Customer concentration, huge. If there is any whiff out there that the build out is near done, these two companies will fall much, much faster than any of the core producers. So if there is some thinking that, well, we're pretty much near the end of the build out, NVIDIA will take a hit, but these guys will fall hard. So be careful. Electrical to optical is also a threat. How fast can you reduce the complexity of active optical, and reduce the power consumption of active optical, even for shorter distances? Discrete retimers embedded within custom silicon. Google, Amazon, Microsoft showing their own ability to say, listen, we don't need to buy ASICs and integrated circuits from other companies. We'll just make our own. That's a big threat for Astera, is one of these hyperscalers, because they only have, 4 customers make up 84% of their revenue. Well, you can almost name the 4, right? If one of them says, you know what, with what we're spending on this stuff, we could just make it ourselves. I mean, if Google can make tensor processor units themselves, and Tesla can make their own chips as well, they can do this as well. They can license the IP and make their own chips. And if they do that, then that's the end of the line for that customer, for Astera. Incorporate connectivity into their own ASICs. So for Credo, here's your big threat: electrical to optical, moving much faster. Because even though they've expanded into optical, they're just not there yet. There are bigger competitors. And here is the big threat for ALABs, is the hyperscalers embedding their own retimers in their own work. As of now, I think the long play is more likely ALABs. The short term, can't argue with Credo's price action. It is killer, and their IV makes it easier to play. So that is the two companies. That is understanding data center connectivity. If you enjoyed this, as usual, click on like, click on subscribe. It does help the algorithm. And if you want next week's companies, I'm doing 2 next week in data storage space. This will be exciting. If you want the infographics for those emailed to you, in the description box below, you can leave your email address. We use HubSpot for our email list, and you'll receive those Friday at 4.